We start talking about the accounting flex fields, and we said that every account in the chart of account has a number. That number is actually divided into segments, and each segment is referring to a particular entity within the enterprise. We said that, for example, if you look at the screen right there, you see that we have a segment for the company, and that's because a multinational organization may have multiple company codes under the whole client. And then each company is divided into different cost centers. You can think of the cost center, if you don't have any accounting background, you can think of the cost centers as departments. And they are, each department of course has a number, and this is, you have to post transactions to that department. So if it is an electricity bill, then you use the department or the cost center to assign that particular expense. The account, as we said, is the particular expense or revenue, and then a sub-account is a subcategory under that expense. So we can have travel as an account, but then a sub-account would be international and local. And then sometimes you may have product, because product, let's say you have different projects, and you are a manufacturing company, so a particular product, you need like to show expenses per that product, and as well as revenue, because remember, you need to make decisions later on in the year of whether to continue production with that product or not. So it's really very important that you report on product. Now, this is not a uniform or a standard chart of account or account structure. Every organization will have its own structure, like how many segments, what the segments are referring to. It all depends upon the particular industry they are in. Usually the industry will have a standard, and they would be following that standard. And why? Because again, the industry will have to report on all organizations that belong to that industry. So it's important that they have commonalities. So if the whole industry is producing a specific product, then definitely you would have product as that segment. Again, so the industry kind of determine how many segments you need, or the minimum at least that you would have to report on. You may add additional ones because of your own reporting needs. It's really very important that you take time designing the chart of accounts, that you take time coming up with the different segments, because it's very hard for you to change once you have defined that structure. So can I well, we will later talk about the parents and the children, but for now you have to think, you have to define each segment and understand the requirements for reporting, for you to come up with an effective chart of accounts. It is hard, as we said. Normally companies do not change their chart of accounts. It is not something that you would change from one year to the other, and that's why it's really very important that you take the future into account when you are defining the segments, the size of each segment, and so on. So here a question is asking, whether you should define project in itself as a flex field. Well, if you read the documentation underneath the slides, it will tell you if you have a project module within Oracle, then you really don't need to define now project as a segment by itself, because you have a whole module that deals with projects. But if you don't, then you would need to add that segment. So there is no a definite true or false. It all depends upon whether you have that module, the Oracle project module, or not. So here is a structure, an example of a structure. You see I have 4 different segments for the account. We have a balancing, we have a cost center, we have a natural account, and then an intercompany. Okay, so independent validation will allow you to validate each segment independent of the other. Each segment has a range of valid values that if you go beyond that limit, then the system will flag you an error. Sometimes there is cross-validation where two segments, the values of two segments are validated at the same time to see if these two segments, the values go with each other. So I think it will be clearer when you see the next slide. So you see here that with the cross-validation, the two segments, the values of the two segments are validated, and you have certain rules that say that certain values do not go with each other. So for example, if I say 01 is the US and 100 is New York, then it is fine because US and New York are okay. But then if I have Asia 02 and Tokyo 400, if I attempt to put 02 and New York, you will get an error. Or if you put 01 and 400, you will get an error. Why? Because these two regions do not go with each other. They do not match. So you have to make sure what with the cross-validation, the validation happens over two segments. So you do not validate unless the values of the two segments are okay. So the segment validation is different from the cross-validation. When we're doing segment validation, we're just validating the values of a specific segment. If we're doing cross-validation, then two segments are validated, the values of two segments are validated at the same time. It is important to realize that the cross-validation only validates new accounts, which means that you have to define the cross-validation rules before creating the account. If, for example, there are like new accounts that you are there are new validation rules that you need to define, then you can define the new ones, but then you also have to run them against the old accounts. We also use the accounting flex fields in order to enforce security rules or the security rules, meaning access to the data and also running reports. So you can specify what employees have access to, what kind of accounts they can access, and what kind of reports can they run. So they can run reports that contain specific accounts, but they are not able to run it against others. So as you can see from from the slide, a particular employee is given access to accounts that start with 0000 to 9999. However, within that range, there is a set of accounts that the employee should not access. So from 1000 until 3999, the employee should not have access to these accounts. So what's actually available is from 0000, all four zeros, to 09999. Once we get to the 1000, then from the 1000 to 3999, they do not have access. But again, starting from 4000 up to 9999, they have access. The question now says, where are you defining these rules? Now, they cannot be defined in financials. Why? Because it has nothing to do, it actually more applies to the employee, a specific employee not having access to specific accounts. So where we define these rules is in the employee profile table, wherever defines the employee as the roles, the responsibilities. We also specify the security rules, what accounts they have access to, what they cannot access, what can they report on, what they cannot report on. So the security rule allow you to give access to specific accounts to specific employees, allow these employees to report, and then restrict access to other accounts that would not involve any of the responsibilities that are assigned to them. Okay, now we talked at the beginning about accounting calendars, and we said because you have different stakeholders, you may need to report at different times to these stakeholders. So for example, for the government, you may need like to report at end of year. So your accounting calendar would be January 1st to December 31st. For stakeholders, like the shareholders, you may have to report by June 30th. So because of the need to have different periods and different start and end of a calendar year, Oracle and SAP allow you to define more than one accounting calendar. So every set of books may have their own accounting calendar, and which means they have different periods, different start and end of the year. We talked about periods, and we said that periods have status. They are either open, closed, permanently closed, or future enterable. They will be open in the future. So every calendar has its set of periods. There are periods, of course, that are defined by Oracle or SAP, like a month, a quarter, a year. But think about like TSU. They have to define semesters, like a fall, spring, summer 1, and summer 2. So different companies will need to define new periods. So you can, both software allow you to define your own period. You can specify, you can use the predefined that comes with every system, like as we said, the month, the quarter, the year, and you can also define new periods and specify when the start and end of each of these periods. So for example, for us, for TSU, beginning of fall may be August 15th, end of fall is December 15th, and beginning of spring is January 17th, and so on. So both software allow you to define new periods if you for specific needs, because you have specific reporting needs. So the question is, why do we need multiple calendars? Mainly because of reporting, because you need to report to different stakeholders, and as a result, you will define different calendars. Their report, their end of year is different. As we said, the government end of year may be December 31st because that's how they file taxes, but you may be required by your shareholders to report end of June. So again, for flexibility, the software allow you to do both. Use the predefined as well as define new periods and define new calendars. Now here are the status of your periods. You have a period is either never open, which means that's if we look at year 2020, there is no way that we would be even recording any transaction. So at this time, the January 2020 is never open. But then we have the near future, like for example May 2015. May 2015 is just a couple of months away. So I may be recording a transaction, not posting it, just recording it, knowing that this is an expense that I will incur in May. So May is future enterable. An open period is the current period that I'm currently in. Now, at the end of that period, so for example, now we are in February, I think today is the 16th, so by end of February, we will reach the end and we will close February. So it becomes a closed period. It is, and that's why when you see there is an arrow back, or there is two arrows between the open period and the closed period, they go both ways, because I can open a closed period. So let's say, as we said, February or January has already passed. I'm now in February, and I get a late invoice for an expense that was incurred in January. Then I'll go back and open January and post that invoice to January and then close it again. So if it is not permanently closed, you can definitely reopen a period. But if it is permanently closed, if we're thinking about 2012 is permanently closed, there is no way that we will go back and post the transaction. You go back, yes, to do analysis, to look at the records and try to see, is there a pattern? Can I learn from my past? But there is no way that you would go and post transactions to a permanently closed period. Okay, another advantage of using SAP and or Oracle is the fact that they allow multiple currency. We are at the very beginning, when we talked about enterprise system, we said one of the benefits of using enterprise system that they are multi-currency. They understand that you may be dealing with a supplier in China or in India, and you need to post transactions in different currencies. So there is what we call the default currency. So in SAP, the default currency is the dollar. Well, I shouldn't say in SAP. In the US, the default currency is the dollar. However, if you move to another country, then even though you are the same company or the same client, the same large client, different company codes, if they reside in different geographical regions will have different default currencies. I can define now a secondary currency or a foreign currency, and these would be currencies that I'm dealing with, that I need like to post transactions in. Now both software, whether it's Oracle or SAP, they do two things. They do translations. So they translate a particular foreign currency into the US dollars using whatever is the current rate, or you specify whether you want to use a current rate or the rate at a specific date. Because remember, businesses do not, and actually that will make sense in the next thing that they offer, is that the software, both SAP and Oracle, allow you to reevaluate the currency. Why? Because they understand sometimes the currencies fluctuate dramatically, and companies may, even though the transaction is already posted, they may go back and revalue because it caused a great loss for them. So it wouldn't be fair for them to keep the old price. So the software allowed them to go and revalue a particular transaction, especially if they haven't paid. So it has been posted, but it has not been paid. So now they have to pay at the new rate. And that's why they go back, and even though the transaction, as we said, has been posted, the currency is revalued, so they do not have to incur the loss. And if they incur a loss, then they can report it as an expense on their income sheet. Now, for every book, you select the currency for it. So, and again, you can also specify, as part of the security, you can specify what kind of currency a particular account can or transactions. You can specify the currency that transactions can be recorded for a particular account. So if you are using international account, you can specify multiple currencies. But if it is a local, you can say only US dollars. I cannot report or post a transaction to the local travel or a local account except in US dollars. I cannot use another transaction because we said that this account is currencies. The functional currency is the same as your default currency. That's the currency that you are working with day in. The foreign currency is a currency that is different from the default. And a statistical currency, this is something that is very interesting in that it does not, you do not use statistical currency to enter amount, you enter quantities. So for example, if you are a tourist company and you want to find out how many people have visited, then instead of reporting the actual value of the packages that they bought from you, you may want to report a statistical currency to show the number of people that have visited a specific region and so on. So this is just like to show you how flexible and how complex the system is. It takes into account so many different things. Okay, now again, we can use currencies and accounts. We have already seen how accounts, the accounting flex fields are used for security. So we have seen that we can specify in the profile for an employee what accounts this employee have access to. You can also specify what currency can the employee post transactions in. So in the user profile or the employee profile, you actually define his or her responsibility. Each of the responsibilities that you define will be tied to a specific book and specific accounts, and will have specific calendar and specific currencies. So now an employee cannot post a transaction in a currency that they are not allowed to post in. So it has to actually be specified in their roles and responsibilities. The many-to-many relationship that you see here is just like saying an employee can assume multiple responsibilities throughout the history. So at one point in time, they may be an AR clerk, an accounts receivable clerk, and then they become an AP manager because they understand the accounting, and then they may be a general ledger supervisor. At any point in time, a particular responsibility is tied to specific books and to specific calendars. Okay, so this is very important that you are able to define responsibilities and to restrict specific accounts, and also you may also note that Oracle comes with its own set of responsibilities already predefined, and you can use these predefined responsibilities and assign them to employees. So if they are an AR clerk, then they have access to specific books and specific accounts. However, you can customize and tailor the responsibilities to add new reports for reporting, for example, and so on. So you don't have to go with whatever is predefined. You can also add or customize these responsibilities. Now here are the different things that you can do within a particular accounting book. You can manually enter transactions. So in the financial accounting exercise that you did in SAP, you have entered, for example, an invoice for a landlord, or you have paid a vendor. These are what we call manual journal entry. You are entering a transaction and posting it to a specific book, specific account for in the subledger. Now, sometimes we need to reverse a journal entry, meaning if a journal entry have been posted, but then you realize you need like to post it to a different period. So let's say, for example, you have an invoice for a service that will happen in March. So even though you have recorded it in February, then you can go back in March when the actual service is conducted, and you reverse it so that it shows that the service is in March rather than February. So reversing is just like of correcting certain things, either because of the, like you are posting it to an entry that is different from when the actual service is conducted. Remember, I told you you cannot accrue an expense or a revenue in a period other than the period when this particular service or product is bought or sold. So if I'm getting a service in March, but I have to prepay in February, then in March I will have to reverse the journal entry so that it appears in March rather than in February. I can also post things, as we said, to a future enterable period. So reversing, you are either you want to post it or change the posting from the current to a future enterable, because that's when the actual service or particular product, for example, will be bought or sold. Recurring entries are entries that are posted only once, and then they recur in multiple periods. So, for example, you may be going like on travel every month, the first Monday of every month. So the first Monday of every month, we need like to post a particular expense registration, for example, for the conference or for training. So you register, you record that transaction only once, and then every month, the first Monday of every month, the entry is not re-entered, but it is reposted. So recurring entries are entries that are posted only once, but then they occur multiple times, are repeated multiple times. And you know ahead of time when you are posting that they will when they will recur in every new period. The mass allocations, now this will become more clear when we do managerial accounting, and that's when a particular expense is allocated to different cost centers. So we can pay one bill for electricity to the electricity company. Let's say we paid $2,000 for that month. Now, it is recorded in financial accounting. That would be a manual journal entry. However, later on, I need to allocate the cost, the $2,000 for electricity, to the different departments that I have within the company. The allocation can be based on square footage, can be based on number of employees that are in each department. It can be based on a specific formula, but you have to understand the mass allocation is reallocation of a particular expense to different cost centers, and this is done in managerial accounting or in control. I think SAP calls the managerial accounting control. So again, recurring journal entries are posted only once, and then they are repeated every accounting period. Like, for example, a very good example that's on the slide is depreciation. Now, irrespective actually of how many hours you have used the machine in a particular period, every month you say that the cost, the depreciation for the machine is X amount. So you divide the life of the machine, you divide the cost of the machine over its life. So let's say a machine is expected to last for 10 years and it costs $10,000. Then every month you will put a depreciation charge of $1,000. You are losing that amount because by the end you expect that it will have a zero salvage value after the 10 years. So again, you define how you will calculate depreciation or the depreciation amount at the beginning, and then the system will automatically post the depreciation charge every month. So you can see that there is actually 3 types of recurring journal entries. The skeleton type of recurring journal entry is where you know the account that you will post to, but you don't know the amount. I don't know how much it will cost me every month. So you set it up at the beginning, and then every period you post the exact amount. And that's an example that's on the board is the temporary labor. I don't know how many hours the temporary labor will work for a specific month. I may set a ceiling, like an upper limit, but then the exact number of hours, yeah, they may not exceed, but they are different every month. So I would just like set up and say I will debit temporary labor and I will credit salaries payable but I do not specify an amount. Now, if I know the exact amount and I know the account that I will be posting, then that's a standard recurring journal entry. An example, as we said, is the depreciation charges or an auto lease expense. So if you are leasing a vehicle, every month you are paying a specific amount, and I mean, like, it will not change. That's a fixed amount. That's a constant. So you set it up at the beginning of the calendar year that we'll have an auto lease expense that's debit, and we will credit accounts payable for $10,000. Now, when I pay, of course, I'm going to debit the accounts payable and credit the cash, for example. But the recurring journal entry is set up at the beginning of the calendar year with the accounts identified and the exact amount. Sometimes I use a formula. So yes, the amount, I'm not sure about the amount, so it is the same as the first one, but I will be able to calculate it using a formula. So for example, bad debt. The bad debt is calculated based on a particular formula. So you set again the account and you specify the formula, and as soon as all of the variables in that formula are identified, then the exact amount is posted. So for example, the rent expense, again in the documentation underneath the slide, it says if the rent expense that I'm going to allocate to the different departments depend on head count. Well, head count will differ because some people may retire. The temporary labor will differ. So at the end of the month, I'm going to see how many were there in that department, and according to that head count, I'm going to allocate to them the specific rent expense. So it all depends upon a particular variable at the end of the period. So here I know the account. I don't know the amount, but the amount will be able, we will be able to calculate at the end of the period. So as soon as the period reaches its end, the system finds out how many head counts we have allocated to that particular department, use that number in order to calculate the rent expense. Same thing for the bad debt. It depends on, again, a specific formula, and once all variables are known, then the actual amount is posted in the book. Now this is just telling you how do we write the formula and what is available through Oracle. So you can add two numbers in the formula, you can subtract a number from the previous line, you can multiply, you can divide. It allows you to have actually a combination of these operators in your formula. And you can have any number of steps. Each step is using an operator and an argument, like add this number, subtract this number, and so on. And in order to be able to post a particular amount to the transaction. If the formula yields something positive, then the account is debited. If the formula yields a negative, then the account is credited, especially if we are talking about assets. As we said, the mass allocations are used for allocating specific expense or specific revenue to different cost centers. This is done in managerial accounting or in control. As you can see, the total rent is paid at the beginning of a month or at the end of a month, and that is recorded in financial accounting. In managerial accounting, I'm going to allocate that rent expense to three different centers: the Chicago, the Paris, and the Tokyo subsidiaries. Each is getting 1/3 of the total rent bill. So you're allocating it 1/3. There are different ways of doing the mass allocation. As we said, we can do it based on square footage. We can do it based on head counts or based on any specific formula. Another thing that you can do in Oracle and in SAP is budgeting. And this is a very important activity for organizations, that before a particular calendar year, they have to define different budgets. And these are like plans for expenses and that they will incur throughout the year. Now, a lot of times, companies define more than one version for the budget. The reason for that is they want to do what if analysis. If I go with an aggressive marketing plan, how will that affect my revenue generation? So they create these different budgets, and the system allows them to create multiple budgets in order to run what if and simulation exercises. Throughout the calendar year, you are always comparing an actual expense or an actual revenue with the budget, with what you anticipated would be. And of course, you're looking at the variance, the difference between the two. Now, a positive variance is not is a good thing, because as you can see, if I have allocated 15,000 for salaries, but I only use 14,000, that's good. So a $1,000 variance is a good thing, because you are spending less than what was expected. But then when we come to supplies, I see that I have used more supplies than was budgeted by 500. And you are looking, the system will allow you to generate reports of all negative variance, so that you would be able to go and control that expense. Why did I spend more than it was allocated? And first find reasons, and then try to manage that particular account. So budgeting is very important, because it allows organizations to create plans and forecasts for what will happen. You can define who get access to the budget. Now, not all, of course, employees will have access to the budget. It's only executives, because if an employee can see that the organization have budgeted a specific amount and that the department is spending less, they will go and spend more. It's only the executives, of course, that will have access to the budget, because their performance, they understand that their performance is based on that a positive variance will affect or will give them a positive performance evaluation. You can now run reports for a particular cost center. So you can see that for cost center 100, what are all of the expenses, what was budgeted, what is the variance. For every, and then you can also run an aggregate budget report, and that's for the whole organization. So it will tell you for what the beginning and end of the accounting period, and it will list all of the accounts and the budgeted amount for each of these accounts. You can also, of course, add as we saw before, the actuals and the variance. Now, you have a financial analyzer as part of a tool that will go back and actually, as we said, do intelligence, do analysis on the budget and the actuals. And this is very important before you start creating the budget for the new cycle. So I need to look at the past and see, is there any pattern in there? Do I need to increase a specific amount allocated to a specific expense, because I'm always having a negative variance? It's not the employees, it's really that I have under budgeted that particular account. So the financial analyzer will help you go and look at the whole accounting period and also compare that to previous ones so that you can better prepare for the coming period. We've already talked about that again, part of the flexibility of the system, that it allows you to create multiple budgets so that you can run what-if analysis and simulations to see the impact of a particular plan on, of course, revenue generation. Now, we all understand that when we define the budgets, we define them for specific accounts. So maintenance, for example, is assigned a particular expense, administration, engineering, and so on. And then we also specify what are the departments that will be used in order to allocate that expense. That's all for financials, and it is a good overview of everything that you can do either in Oracle or in SAP. Just like to sum up or to wrap the whole thing, we talked at the beginning on how do we set up the financial module, and we said the very first thing is really to define the chart of accounts before we can record anything, because the chart of accounts is the structure that will define how you will create, or what kind of combinations you will set for each account number. So the chart of accounts lists all of your accounts, and it specifies how you will come up with a number for each account. We talked about that this number is actually usually divided into segments, and each segment refers to a specific entity within the organization. We talked about the segments having ranges, so they have a size like 2 digits, 3 digits, and they also have a range of values. We talked about validation of the segments, that the system will always see if whatever number you entered is within the range or not. Some of the segments may be cross-validated, so we talked about geographical locations. If I'm entering an account that belongs to the US, there is no way that I can specify a city that does not belong to the US, like Tokyo, for example. So we talked about cross-validation, combination of segments that are validated together. We talked about accounting calendars, and we said that both SAP and Oracle allow you to define more than one calendar, and the reason that you would do that is because of reporting needs. We talked about an accounting calendar having different periods and the periods having status. So I may go with the month as a period and the quarter and the year, but I may add additional periods, like in the case of TSU, we talked about a semester being another period that I will define. We talked about the status of the different periods. The period can be open, closed, permanently closed, future enterable, never entered. We also talked about currencies, that these systems support multi-currencies, and there is a need for you to define or associate a particular book with more than one currency, because some transactions are used in order to buy, for example, a raw material from China, so I have to pay in a currency other than the US dollars. So the system allows you to define what we call a functional currency or a default currency, and also secondary currencies or foreign currencies. And we also heard about statistical currencies, and these are used, for example, like quantities rather than amounts. They use specific formula. We can tie a specific currency to a book. We can specify in the responsibilities of employees. We can specify what kind of currencies they can use in order to post to a specific book or when posting transactions. We talked about the different types of entries that we enter in any of the accounting books. It's either a manual journal entry, like posting an invoice from a landlord or um, posting an invoice to a customer. There are recurring journal entries. These are repeated transactions, and either I know ahead of time the specific amount that I will incur every month, so that would be a standard recurring entry, or I may know only the account that I will be using, but the amount will really depend on a specific thing at the end of the period, and or a specific amount, like for example labor. I don't know how many hours the temporary labor will work, so I set a skeleton recurring entry. Sometimes now the amount is calculated based on a formula, and one of the variables, one of the values that I need in order to calculate the formula is a variable that again will be determined at the end of the period. So at this point I define a formula recurring entry, and once the system can identify the value of the variable at the end of the period, it automatically calculates or posts the transaction. And then we talked about budgets, and we said these systems, the ERP systems, allow you to define multiple versions of the budgets. The budgets are a plan, a financial plan for a new period. It specifies a specific amount that is assigned to each of the accounts. The budgets throughout the year, the system keep track of what is actual and what was budgeted, so you can see whether you overexpended or for a specific account, so that you can go in and control that. We talked about system being able to assign again view or reporting on the budget to specific responsibilities. That's all for the financial accounting. Please listen to the videos before you attempt to take the quiz, and the quiz will be posted today, and it will remain open until Sunday. Thank you all for listening.